Household debt is one of the most wonderful financial instruments in the entire world. It has enabled countries and their society to increase domestic consumption and enable them to fix housing problems. People could now buy a house through the availability of mortgage loans and even purchase other lines of products and services through consumer loans. In many ways, household debt has increased economic activity all around the globe. However, while it is regarded as a quote-unquote economic driver, it is also one of the causes of major economic catastrophes. They are often the ones blamed for the subsequent US and European economic crisis from 2007 to 2012. This is because once the household debt is overused, the debt often outweighs any positive economic impact, and individual borrowers who once leveraged it would either not be able to pay it, or worse, declare personal bankruptcy. And when it is done on a large scale, such as the entire population of one's country, it becomes pretty terrifying. One of these nations that have reported record highs and alarming levels is the nation of Thailand. The Southeast Asian nation is also one of the world's most famous tourist destinations. Although despite its booming economy, the society is well known for taking on a lot of personal debt. According to the Central Bank of Thailand, the country holds a worrisome household debt ratio to GDP of about 89.2%. This means that the country's entire household debt is almost equal to the country's annual economic output. Further, the same figure of 89.2% is also the highest in the entire Southeast Asian region, more than countries that have better financial systems and are more likely to have a higher household debt, such as Singapore or Malaysia. Furthermore, it is also one of the highest in the entire world, and is also registered to be a 16-year high for the country's record. This is why the governing bodies, from the politicians themselves to the country's official bankers, have cited that they're doing the best they can to try and lower this before it causes unprecedented economic fallacies to the country. The most problematic issue, however, is not just about household debt being used. It is when it is initially implemented that the stakes rise to the point that alarm bells ring. Only then will they realize that going back would be extremely difficult. If this happened to many developed nations globally, with the best economists, government officials, and hired parties unable to completely fix this issue, how would Thailand then fix it? But at the very least, there are still many ways to actually fix a country's household debt crisis. Before we go into how Thailand is doing it, let us first discuss what really caused all of this dilemma. Thailand's household debt has emerged to also become the most notorious financial concept for its citizens. After all, many numerous surveys have found that more than half of the entire population in the country is in debt. And what is even worse to note is that some surveys conducted across the country have also found that these very debt holders have indicated that they're having difficulties paying for their repayments. They have cited that their incomes have fallen, along with the rising cost of living in Thailand and terrible economic conditions. This entire debt hurdle, however, is what we're experiencing today. To understand how we got here, we must first look at how much these people, on a per capita basis, actually hold. The average household debt in Thailand is about 501,000 Thai baht, or over 13,300 US dollars. In contrast, the average income per household in Thailand is just around 27,352 baht per month, or on an annual basis, approximately 328,224 Thai baht, or 8,700 US dollars, which can easily suggest that the average household in the country has more debt than its annual salary. Furthermore, the entire scale of how much Thailand's household debt really is estimated to be over 14.6 trillion Thai baht, or over 388 billion US dollars, which is, as we noted earlier, almost 90% of the country's total annual gross domestic product. Likewise, the figure has risen due to many factors. We can first blame it on the COVID-19 pandemic, since it has caused houses and businesses to close down, and with the disrupted employment industry, many people turned to debt. However, while that indeed may have caused an increase in household debt, we're still missing out on the largest factor: the entire financial system of Thailand. You see, there's a strong argument that explains why nations such as the Philippines or Indonesia have lower household debt. It is because their financial system is not adequate yet, and people can easily borrow money from the banking industry. However, Thailand has emerged to have a higher household debt ratio because it has created flourishing banks and easy access to loans. Much of the household debt registered in the Philippines or Indonesia are often unregistered loans. One example is from loan sharks. Thailand, on the other hand, has seen its households be less reliant on these unregistered and unsafe means to borrow, and focusing more on implementing an actual financial system. Henceforth, the real explanation why Thailand's household debt has become overly high is not because of a failure in the system. Rather, it was because they had fixed the entire borrowing dilemma, where people can borrow safely from proper institutions. This is why, even before the COVID-19 pandemic, Thailand's household debt has already increased quite a bit over time. Data way back in 2004 shows that household debt was already over 60%, and by 2016 it was at 80%. This figure has already been astoundingly high, especially when we compare it to a historical perspective across other Southeast Asian nations. And the argument for this is, as we noted earlier, due to the capabilities that Thailand was able to deliver. A better and more robust financial system that caters to its society. But the problem with the financial system is that while it is built properly, it forgot one factor. A term is known as financial literacy. You see, there are two kinds of debt, good and bad debt. Good debt is mostly investments, or as usually known, mortgage loans. These are used to buy houses, real estate, and other property factors. This is one of the reasons why Thailand's debt is so high relative to its income. They've used it to buy essential assets. However, while this may be true for Thailand, it is only a part of the entire household debt. Data from the central bank shows that only 34% of household debt is linked to mortgage loans. In contrast, Singapore, a country with less household debt to GDP ratio, has over 74% of its household debt tied to mortgage loans, which are nearly double that of Thailand. This can suggest that while Thailand's household debt is high, the only good part of it is actually tiny. But then the question arises, what is Thailand's household debt composed of? Well, as we mentioned earlier, a fraction comes from mortgage loans. The other types of loans come from private consumption, such as credit cards and personal loans, auto loans, and a long list of different instruments. This different type of debt makes Thailand's figures quite problematic, because it is not composed of good debt, but rather the exact opposite, bad debt. Of course, this is very important, since debt is an instrument that can make someone rich, but when it is used too much, and when society is given an instrument they do not know how to use correctly, it does not become an economic driver, but the exact opposite. Now, fixing these, of course, is not entirely impossible. The government is doing whatever it can to slow down household borrowings, and possibly avoid an economic catastrophe. The first and foremost decision the country is now taking is increased interest rates. While it is an instrument that is being used to combat the inflation rate, it's still an instrument that the central bank can leverage to lessen the borrowings of its people. After all, a higher interest rate means everything related to borrowing will be more expensive. Secondly, besides increasing borrowing costs, they also cited that they want to establish regulations around loans. In simpler terms, it means that it will be harder to borrow now due to increased costs and government interference. Finally, the largest hope of the government is to rely on the economy of the country. Reducing the household debt to GDP can easily be done if they can increase the entire economy and increase their citizens' income. This is why there's still somewhat of an optimistic view of the future. Some arguments that still pose an optimistic view are related to the per capita of Thailand increasing in the near future, as the world has already opened its borders, and a dramatic change is expected in the world of tourism. Moving on, while Thailand may anticipate a potential household debt crisis, let us also not forget that these have all happened because Thailand's financial system is intact. Unlike neighboring countries or similar economic levels, Thailand has allowed its citizens a more accessible means of taking a loan, which battles out the unnecessary informal loans that sought a far more terrifying momentum to its society if done wrong. This is one of the plus sides to Thailand's household debt, but to truly fix this, we believe what needs to be applied is financial literacy, something that the country is still missing out on. Of course, retraining the entire population on it is probably not going to be possible. But what we can see, however, is that the entrance of the financial technologies that allow e-wallets to e-borrowings will more than likely help them take a closer look at what they're borrowing, and to be able to keep tabs on whether they can continuously borrow or not. After all, transparency is vital in helping reduce this issue. But anyway, these are just some of the points we would have mentioned, as Thailand's household debt can have a lot of potential for a fix, and probably more fallacies to occur. Do let us know what you think, however, how you think Thailand can fix its own problems, and if there are any potential fallacies that we or anybody is missing out on. Thanks for watching.